Good evening. Welcome to Weekly Market Wrap Up. The Indian equity benchmarks ended the week with minor losses on rising global recession fears after muted economic commentary from around the world and the Fed Reserve's continued hawkish stance on the economy. The domestic markets remained choppy during the week. While Sensex and Nifty returns were flattish, the mid-cap and the small-cap space saw interest from the market participants. Both these indexes outperformed their large cap peers during the week. Capital goods and realty indices were key gainers, whereas IT remained under pressure after weak global commentary. Auto stocks also gave positive returns during the week amid reporting of sales volume numbers by auto companies. For a 1 year period, the Nifty has erased its losses and is up 1.25%, while the Sensex is up 1.16%. In the near term, the Indian markets are likely to continue tracking its global peers. During the week, the most anticipated economic event of the summer happened, where Jerome Powell, the chair of the Federal Reserve, provided an update on the economic outlook that detailed how the central bank is thinking about inflation and the path ahead for interest rates. For the Fed, which has been raising interest rates rapidly to keep down the fastest rate of inflation the US has seen in the last 40 years. The Federal Reserve enacted a second consecutive 0.75 percentage interest rate hike, taking its benchmark rates to a range of around 2.25% to 2.5%. Powell signaled that the US central bank is likely to keep pushing interest rates higher and leave them elevated for a while to curb inflation. And he pushed back against any idea that the Fed would soon reverse its course. The Fed's stance on inflation 4 decades ago, the last time the prices were increasing this higher, led to a high unemployment situation that impacted the US economy badly. It is to be seen, however, how this year's stance results into. The investors will be also awaiting the key US job numbers scheduled later for today to get an idea for the direction in which the US economy is headed. Coming to the Indian GDP numbers. The Indian GDP grew by 13.5% during Q1 of FY23, aided by private consumption growth. It crossed the pre-pandemic levels, rising 4% compared to Q1 of FY20. However, sequentially, the gross GDP contracted 9.6% in Q1 compared to Q4 of FY22. The RBI has retained its forecast for GDP growth for the current financial year at 7.2%. The gross value added, the GVA growth, stood at 12.7% year on year, wherein the services gained the most of as the economy functioned at nil restrictions in Q1. Manufacturing sector, however, failed to boost the economy even as the PMI expanded 54.4 in Q1 on an average. The gross fixed capital formation (GFCF), which is used as a proxy for investments for the economy, grew by 20% in Q1 FY23, contributing to almost half of the GDP growth. The gross fixed capital formation stood at 34.7% of the GDP in Q1, up from 33.7% in Q4, and at the highest level seen in the last 10 years. The import growth of 37%, led by high commodity prices, surpassing the growth of exports of 15%, led to the drag in the GDP. However, compared to the pre-pandemic level, private consumption was 9.9% above pre-COVID levels, while government consumption was up 9.6%. Credit growth has been a major driver for private investment revival, especially the MSME segment. This increase in bank credit, mainly fueled by working capital requirement, is a reflection of improved investment demand in the economy. The RBI data showed that the credit to industry grew 10.5% in July against a mere 0.4% last year. The credit growth can be attributed to several factors, which are supporting demands for loans like revival of private capex investment, substantial deleveraging by capital intensive companies, rising commodity prices, and implementation of the PLI scheme. Size wise, credit to medium industries grew 36% in July, while the credit growth to micro and small industries rose to 28.3%. The large industries segment saw a credit growth of 5.2% against a contraction of 3.8% in July 21. The Indian economy is poised to witness a broad based and a much awaited revival in its private capex. The businesses have already started ramping up its capacities as domestic demand recovers, indicating early sign of a turnaround led by sectors like metals, mining, chemicals, electronics, where investments have already started to pick up. Thank you. That's it from my side.